After a stunning $1,000 run higher for gold and a $15 run higher for silver, including a red hot, frothy blow off top, gold and silver have gone into a profit taking correction and into a consolidation mode. In this gold market update for Friday, October 31st, happy Halloween, everyone. I'm going to review with you where we are in the current market for support and resistance levels for gold and silver, and also review the last time we had a red hot gold market in April to show you how that correction and consolidation phase evolved. And I think we'll have a similar one this time. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We're a national, physical, precious metals and vintage U.S. gold and European gold coin dealership. If we can help you with any of your needs in the physical precious metals arena, we'd be honored to help you and to try and serve you. So let's get on with our update. Gold and silver market correction analysis, what the previous correction tells us about the current correction. Gold's testing 3,900 and holding. Silver has tested $45 an ounce and is holding higher. We'll go through the 7 phases of the last run higher and profit-taking correction. Remember, the fundamentals that have driven this market to record highs for gold and silver and cyclical highs for platinum and palladium remain firmly in place. We've got record physical demand around the world, record high debt. The U.S. just went over $38 trillion in debt this week. And we've got ongoing trade wars around the world, despite President Trump and President Xi just shaking hands and agreeing to agree for the next year. These conflicts are going to continue. And of course, we'll get into technical support levels and resistance for gold, silver, platinum, and palladium. This is a chart that I drew up in the springtime that showed how gold reacted to the Chinese tit-for-tat tariff trade war that we got into with China. China was the only country that stood toe-to-toe with the U.S. because they're the only country that really can. And when they did, President Trump ratcheted tariffs up on China to 145%, and they ratcheted tariffs on us up to 125%, which drove the Chinese into a gold buying frenzy. And they drove gold $500 higher all by themselves in a very short period of time to a new all-time high. And then we went into a corrective phase. That was triggered by President Trump signaling that we might be able to ease the tariffs and actually get along a bit better. And that's what broke that rally, which led into the corrective consolidation phase. So this is a much cleaner chart with gold starting well below that at 2720 support and resistance. Then we had 2978 support and resistance as we got into the ratcheting up of the tariffs. We broke over the previous high and set a new support and resistance level at 3185, and then we ran all the way up to 3434 resistance before the correction occurred. So let's drill down a little bit tighter on that real $500 run higher to show you the phases of a run like this, which are very similar to the run we've just gone through. First of all, you've got something that sets it off. In this instance, it was the tariffs on China and the tit for tat ratcheting up of them. Then that caused a dramatic surge of buying in China. Because if you're a Chinese investor and you're told suddenly that your best customer wants to charge you 145% of the value of your product to sell it to them, well, you're not going to sell many products. And if you're a Chinese investor, you have stocks to invest in or real estate, and both have faltered badly since COVID, and precious metals have done well. So the Chinese went on a gold buying spree that we haven't seen the likes of for years, driving the price higher. So fundamentally, step one was fundamental buying that drove the price higher. And as the price moves sharply higher, you start to get momentum traders following the trend. And then they start to buy in. and they drive the price higher. And that's when speculators can really take it to that next level, a very frothy, toppy level, as they continue to buy into the trend themselves and drive the price to a peak. And at some point in time, buying exhausts itself, or there's something that happens that triggers a sell off. And in this instance, it was President Trump indicating that he could ease tariffs back down on China a bit because that whole cycle was getting out of hand. And that tended to break the rally. So, one, physical buying, two, momentum traders piling on, and three, speculators buying into the trend and driving it sharply higher. Those are the three steps on the way up. Then what happens? Step number four. Usually, the last people in, the speculators, are the first people out. They can roll over and sell their position very quickly uh, in the futures market, driving the price down sharply. And what happens as the price falls, it begets more selling, first to lock in profits and then stop losses. Then, as the momentum continues, speculators can actually pile on and start to sell the market short, which drives the price lower than it might fundamentally go in a corrective phase. And then when selling exhausts itself and buyers start to see value and come in, what you have to get next is a short covering rally where the short sellers are now forced to buy the contracts they sold to lock in their profits and stop losses. And that's how you get those couple of one or two knee jerk ups and downs that follow the immediate peak, which is the speculators really trading the momentum of the market and value shoppers trying to figure out where value is and sellers, trying to figure out where the profits can be taken. So you tend to get a couple of knee jerk moves higher and lower before you settle into a range that becomes then a trading range. And in this instance, because it was fundamentally driven by buying, the trading range actually settled in higher than the lows. Uh, and the market would prove to be very, very resilient for the next 3 or 4 months, with the trading range being less volatile and narrower and higher than the bottom, but holding at the top. And this is a classic consolidation phase following a top. So let's see how that applies to the current market that we're in now. All right, so this is a 1-year gold chart that shows that Chinese-driven run on the lower left half of the chart, and the upper right half of the chart is the run that we've just gone through, driven primarily by Indian buying leading the way, followed by momentum traders and then speculators who drove the market into a very frothy top. In 1 week alone, gold went up $400 and silver went up $5 an ounce, which is a very frothy top. It's not quite the same kind of a topping formation that we saw in that episode in April, in that speculators really piled into this one. So when we got into a correction so far, we haven't settled near the top of the correction like we did the first time, but we're settling into a more stable range, holding in about half to 2/3 of the gains of the way up at $3,900 gold, with resistance in the short term now at 40.50. So this blow off top was much more of a blow off top than we saw in April. And on a 6-month candlestick basis, you can see that pretty clearly how gold just after grinding higher for the first 2/3 of that run, just really took off once it got over $4,000 an ounce, hit the wall at just under 4,400, and then we had just a bone crushing $200 day down in one day as the market reversed itself, and those longs became shorts and push the price down. And now we're settling into that 3,900 to 40.50 trading range. This is the December gold COMEX contract. I look at this all day long, every day. This is a chart that goes back to September 8th that shows the trading in 4-hour ticks to get it all onto the chart easily for you to see. It shows a gradual move and then a faster move and then a more parabolic move higher. I drew that rising red trend line to show myself where the bottom support was on the way up. And then we blew into that blow off top, a double top at 43.98. Then that hard selling when the market turned over. I had first support at 41.77. We blew right through that. Second support at 40.74. We blew through that. Third support at 39.69. We're holding now with resistance at 40.74 and support again at 38.62 and then 37.65. And if you look at those levels, you can see that's where the market kind of bottomed in that upward channel to start with on the way up. So it's not that technical, but if you watch this all the time, you can see these trends pretty easily, like I do. So this is what gold looks like on the COMEX contract going back in 4-hour bars to September 8th. And here's the 1-year silver chart. Silver is much more dramatic because it did not enjoy the same gain in April that gold did, but it got turbocharged after we tariffed India on August 28th. There's a couple of factors here that are really pertinent for you to understand regarding silver. Number one, India is the most populous country, and they have a huge gold and silver culture like China does, the second most populous country in the world. The tariffs on India, 50%, set this rally in action, but there was more fundamental forces at work as well. India has Diwali season in the second week of October. And there's an Indian influencer who has 3 million listeners. He told his listeners that they should buy silver this year in lieu of expensive gold. And that helped to put the strain on the London market and break the London market. And that's indicated on the chart. And again, once this market really got going, it got a real head of steam under it. And then the speculators piled on and drove it to a frothy top at 54.20 on the New York close. And what really broke the market's support was fundamental buying that kind of ended due to higher premiums for silver and, most importantly, the end of the Diwali festival in India, which took one of the fundamental support legs out from underneath the market and helped to stimulate the correction that we've gone to that's now leading to the consolidation phase. So for silver, I see support at 46.50 and resistance at $49, although we might have to raise that resistance level because it might look a little bit low at this point in time. I really think we'll push that up to $50, and support will raise up a little bit as well because silver is proving to be more resilient in the short term than I thought it might, especially after the big gains that we've had. We did have just an absolutely frothy top, which would be a little bit challenging to regain that in the short term, but I think we'll grind back up to that as time passes because we are in a full-on silver squeeze. The market's still very tight in London. There's demand in the US right now, and there's just not enough product to go around. The sovereign mints are behind in production, and they can't keep up with the current rate of demand right now. A lot of that has to do with changing over from 25 to 26 states, and the mints are kind of caught in the squeeze right now with their pants down. Here is a 6-month candlestick chart showing the same price action. And again, we got into a very frothy top over $49, which led to a pretty sharp correction. But again, we're settling into a $46 support level to a $49 resistance level on this chart. And I do think I'll have to raise that resistance level up to $50 because I do think silver is a buy under 50. Here is the COMEX chart, which shows a similar pattern to the gold COMEX chart that I showed you. Again, this is 4-hour bars going back to September 8th. You've got a mild increase that leads into a run higher and then a kind of a blow off top with a pretty sharp correction. And on this chart, I've got support at 47.12, again at 46.27, and then 2 levels below that with resistance at 49.21 and 50.54. I think we're probably going to take out that 49.21 resistance level very soon, and the market will continue to grind higher because of the squeeze that we remain in, which is particular to silver and not gold at this point in time. Here's a 1-year platinum chart. I've left this chart pretty much alone since the last 1 or 2 times I've shown it to you, with support at 1550 I do think that little blue trend line to the upper right that we see will get back over that as time passes. We did break down below 1550 pretty sharply, but we've rebounded pretty quickly. And that little curly Q pattern off to the very right, that's a classic pattern for an up move. So I do think platinum is particularly desirable in Asia, in Japan and China, as a substitute for gold in jewelry, which is almost 3 times as expensive right now. So I think that's going to help to underpin the platinum market pretty sharply right now. So I do like platinum if you can buy it under 1600, and especially if you can get it under 1550. I think it's going to prove to be a real buy because of the substitution a lot of jewelry buyers will make for gold with platinum going forward, the way the pricing is for those two metals. On a 6-month candlestick chart, you can see something similar with, again, support at 1550. We did have just that one horrible day where platinum dropped about 200 bucks and then rallied sharply on a lot of buying. And it's shown a pretty firm pattern thereafter with support at 1550, one more little break. And the market's firming up nicely. I like the way the platinum market looks right now for further gains, probably in a bit of a grinding manner. Here's a 1-year palladium chart with support at 1400. We've gone under that just a little bit, and resistance now I've put in at 15 and a quarter. We're not going to see the same kind of substitute demand for palladium for gold like we're going to see for platinum for gold for jewelry, because palladium is just not used in jewelry. That's why I think platinum will lead palladium higher, like being the big brother to palladium, just like gold is the big brother to silver. On a 6-month candlestick basis, you can see I've got support just a hair lower at 1380, again with resistance at 15 and a quarter. And we're starting into a nice solid trading range with the bias towards the upside just a little bit. So I do like palladium at these levels. So with the government shut down, we haven't been getting much economic information to drive the metals one way or the other in the short term. But what we did get was a second 25 basis rate cut point from the Fed 2 days ago at the conclusion of their meeting. But what did happen was Chairman Powell indicated in the presser following the FOMC meeting that a third 25 basis point rate cut for December, which the market virtually thought was a lock, was anything but that. And what we've seen are yields on the 10-year and the 2-year Treasury perk up quite a bit with that information being provided by Chairman Powell. So higher yields typically pressure gold a bit, but we're really not seeing that right now. So I don't think that this is going to be as material as it might have been in the past. Could be a bit of a knee jerk in the short term. But we may not get another 25 basis rate cut in December based on how the economic data comes in between now and then, which has helped to raise yields on the 10-year and the 2-year Treasuries, and has helped to buoy the dollar up just a little bit as well out of that downward channel that it's been in for the last couple of months. Typically, these would pressure gold and silver a little bit. Again, we don't know when the government will reopen, so we don't know when we're going to get any inflation data or any employment data going forward. And those are two of the main drivers of the Fed and of the markets right now. So that's our update. After a red hot precious metals market, the likes of which we haven't seen for decades, not since the late 70s, we've gone into a corrective and consolidation phase. And I want you to remember that this has been a fundamentally, at first, massive global buying spree that has helped to buoy these markets to record highs for gold and silver and cyclical highs for platinum and palladium. And none of the fundamentals have changed. What we've done is taken some of the speculative frenzy that got into the market out. And now we're going through a healthy correction phase. And if this one's like the last one, it will be fairly short and fairly shallow based on the trends that we're seeing. So I do think that this is a great opportunity to add to your positions if you're so inclined to do so. I do think silver is probably one of the most fundamentally good values in the market, followed by platinum, gold, and palladium. But I do think gold will continue to be the leader as it has been. So if you like what we're doing, please subscribe to our channel. And once again, happy Halloween to everyone. And thanks for your time today.